My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but to educate, put things in context. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. All right, let me tell you how to approach this market after yet still one more hideous decline. Dow slipping 340 points, a lot at the end. S&P sinking 0.97%. And once again, the NASDAQ tumbling 1.15%. I need you to understand that there is another way to look at the market other than what we're seeing on our screens, other than just throwing your hands up and feeling sorry for yourself and the pain you're enduring because of some well-known factors. We all know the litany of woe, but let me toss them up and then shoot them down. Ready? It's not the broken supply chain. It's who can triumph over the broken supply chain. It's not the jump in raw costs. It's who is the brands that allow them to pass those costs on to the customers. It's not the inevitable rate hikes from the Fed. It's who can thrive in a higher interest rate environment. Who will make more, not less money when the Fed does the inevitable. See, that's what matters, particularly now when we're getting into the grist, the meat of the earnings season. I want you to stop focusing exclusively on how many rate hikes the Fed will hit us with. Just stop it. Rate hikes won't kill the whole stock market. Historically, the world's averages have rallied nearly 7% on average in the first year of tightening cycle. Rather than writing off the whole asset class here, you should be trying to pick the stocks of great franchises that are getting hit because of market-wide sell-offs. I play with an open hand, as anyone who is a member of our investing club knows all too well, because I talk about our gaffes as much as I do our successes. We're not crying in our Coronas and Modelo's about what happens if Jay Powell gets sick of all the hedge fund hectoring and decides to join him with a series of lockstep rate hikes that wipe out the economy. You have to have a big-picture worldview that includes the Fed, but at the end of the day, talks about the companies. We're trying to pick stocks, not the timing of rate hikes. That's not the. I'd rather do that on DraftKings. It means looking for companies with the best franchises, not treating all stocks like they're interchangeable bushels or weed or barrels of oil. Think about it. Are all quarterbacks interchangeable? Do you want Jalen Hurts or Tom Brady? Is Aaron Rodgers the same as Baker Mayfield? Are the New York Giants equal to the Buffalo Bills? On Wall Street, way too many people act like the answer is always yes. They're so focused on the big picture that they don't care about the individual companies. They don't listen to the conference calls or read the slide decks. The only way they look at it, they want the consumer price index. They want wage inflation. That's what they want to look at. They're not willing to get their hands dirty with these quarterly reports like I do. And you know what? I don't blame them personally. Really, personally, I don't. I'd rather read a conference call, though, than a novel, unless it's a Stephen King masterpiece. But I'm a freak. I'm an audit. Most people doing the homework is actual work. However, it gives you institutional memory. I enjoy it. I remember how good or bad a franchise has been over the years, and it lets me get a better read on management now. So let's start with the obvious. In the old days, I was never a real fan of Bank of America. Big, unwieldy, always running into trouble, very little customer loyalty. These days now, no, it's now technologically superior, which you know if you have an account with a bank like I do. It's a huge asset gatherer, and it's got a lot of customer loyalty because it's digitized. You may say, who cares? I look at the mosaic and I say, wait a second. That's sticky money that goes nowhere, regardless of whether or not the Fed tightens. Thanks to Bank of America's scale and its constant growth, its enormous account base will throw off $6.5 billion in new revenue if the Fed hikes 4 times. $6.5 billion. In other words, this is an institution that thrives on rate hikes. So when we see the numbers it reported today, I think it deserved to rally a lot more than it did, frankly, because 2022 could be the year of Bank of America. I thought this was more like it. This was more the market, not Bank of America. So take Morgan Stanley. Here's a franchise that used to be so episodic it made me sick, drive me crazy, up, down, up, down. That's one of the reasons why I didn't want to work there back in the day when I had the chance. Then later, I figured it would do something to run afoul of the regulators, so it was too dicey to own. These days, though, Morgan Stanley just added $430 billion of net new assets last year, bringing total client assets to an astounding $5 trillion. Do you know how much a good investment bank can make off $5 trillion? Hey, how about $3.7 billion? Right there. And that's just by having a great franchise, which is something we spend real time on in our 10:20 a.m. morning meeting. You can tune in when you join the CNBC Investing Club. We talked about the brand name that is Morgan Stanley. It's a Super Bowl franchise that can withstand something that a Jacksonville Jaguar team can't, right? I mean, they're not all the same. They're not the same. CEO James Gorman has transformed Morgan Stanley into something that's totally consistent. While no major bank is immune to government scrutiny, I think these guys are the closest thing to squeaky clean. Now, most people who read these quarterly reports or look at the decks are specialists, and they focus only on a single sector. I have no sector. Never have. I love all companies, all sectors, albeit not all the time. That's why I was blown away by the market share gains and relative sales growth that Procter & Gamble reported today and gave us. Look at this one. Now, I got to tell you, I am sure many people's eyes glazed over when they saw overall organic growth was up 6%. Doesn't sound like that impressive, right? Oh, but that means you don't know what you're looking for. Maybe that's why the stock barely budged when the numbers first came out. Right here, it went down, and I'm screaming and screaming. Will someone go buy that thing? That's right. Scream at the TV. Buy it, buy it. Don't people remember the bad old days 8 years ago when we endured open rebellion by the analysts because Procter was so poorly run? How quickly people forget the huge dry spell where we had to endure gigantic market share gains by Unilever in the so-called underdeveloped world. Now Unilever's so panicked, they're trying to throw away almost $70 billion for brands from GlaxoSmithKline that have a fraction of the loyalty of Procter & Gamble. This is now a company that's simply filled with all-stars. But it wasn't always a playoff team. You know, Procter's a contender because even though it had $2.8 billion in commodity, freight, and currency headwinds, it could pass those costs on to you, the consumer, without batting an eyelash, because not all brands are created equal. Procter's are created better. And that's how this stock could rally in the end $5, despite the onslaught of machine selling. It wasn't people, machine selling. Maybe they're worried about what Biden's saying. I don't know. I'm worried about companies. 2 weeks ago, we got hit with a lightning bolt. A terrible Medicare Advantage number from Humana, which is supposed to be the king of the Medicare Advantage business. Now, I've been trying to figure out this whole Medicare Advantage thing, and I got to tell you, I got like a chief Medicare guy because it's so hard to understand. But that person likes United Health. Doesn't matter. When Humana's awful numbers came out, United Health got hit too. Then, when United Health reported this morning, the analysts, they had their knives out. They were all set. They're trying to carve up the quarter. UNH is a fabulous company, and they didn't have any Medicare Advantage problems. Turns out the issue was a little bit more Humana-specific. Instead, United Health reported an insanely positive number. Insanely positive. Now, again, this was more right than this. This is the machine selling this. I got to tell you, this was an opportunity, all right? Just an opportunity, plain and simple. Because of this Optum Health unit, wow, I think the stock would have been up a lot more. Of course, because I have a long memory, I can recall 16 years ago when United Health had a terrible option scandal, and all they seemed to care about was enriching themselves, not their shareholders. It's incredible how the culture has changed. I like that. Oh, I can hear you. Kramer's cherry-picking all the good ones. He's created an all-pro team for tonight's show because the market's down. Wrong. These just happen to be the biggest companies that reported today. The biggest ones. Hey, maybe tomorrow we'll have some clunkers. Heaven knows you don't want to be touching an unprofitable company that makes nothing and has a lot of competitors, which is about probably half the market I see. But the bottom line, real companies doing real things with tremendous brand loyalty are what will triumph in this environment. You just need to know where to look.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.